So the purpose of this channel is to help you master relationship banking, make those banking relationships profitable, and leverage those relationships to increase your net worth. In this particular video, we're going to be covering that rent and utility payments will finally start building credit and how you can use it to your benefit. For those of you who have been paying your bills on time, your rent, your utilities, your phone bills on time, you'll finally start getting credit for these payments to help actually building your credit profile and score. And this is going to be a game changer for those who can benefit from this. So I'm going to give you my talking points and my notes is for those of you who tune in regularly, know I do in these videos, so we can keep it short, sweet, and to the point. And the first thing I want to cover is what's going to be reported, how it's going to be reported. As we already talked about, rent, utilities, phone payments, phone bills, all of this stuff now can be reported. It has to be done through reporting, self-reporting services. So I want to be clear about this. This does not mean that you will automatically start having these payments go in as you make payments every month when you go to your utility companies, phone companies, or when you pay your landlord or property management company. You have to go through self-reporting methods. You have to go through self-reporting platforms or companies. Experian is a really good example where they will allow you to upload, you basically log or link your checking account that you're making these payments out of, and Experian auto scanning to tell which one of these are rent payments, utility bills, and it'll pull it into your report. The difference is that these scoring models like FICO 9 and updated versions of Vantage will allow you to actually get scored on these things, and previous models did not. So I want to be abundantly clear about that because I know that'd be confusing. You're just thinking automatically in 2026 that your bills are going to just start showing up on your credit report. You do have to take the step to self-report them and allow, once they're self-reported, the actual scoring models will actually account for them and help build your credit report. So how would I advise you to move forward with this if you are my client? Mostly, this is an upside opportunity. What that basically means is there's very little chance for downside. The potential downside is if you start to have any kind of collections. Once this starts to report, if you self-report and plug it in and it picks up every month, if you start to fall behind on those bills, then obviously that's a potential risk of a downside in that scenario. But that's clearly the case anyway, because these same companies and entities reported non-payment anyway if you got too far behind. So that's not really a new concept, but instead of it maybe getting to collections before it got reported, if it's self-reporting, it could just start to track late payments. So keep that in mind. That is a little bit more of an update in that department. If you're just falling behind, but you hasn't gotten to the point where they're no longer collecting and have sold it off to some collection company, then you can start to actually have those late payments. If you're 30 days, 60 days behind, and it's still an active account, that could catch up and bite you. This is great for thin credit files. And I am a huge proponent of talking about credit profiles over credit scores. I am a banker by trade. I'll talk about that a little bit more towards the end of the video when we close out. But I see clients that have great credit scores and thin profiles struggle. And I see clients who have average or below average credit scores still pull off approvals. So it is very important to understand the density of the information and data in your credit profile beats out a polished score with limited data. I'm gonna say that one more time. The density and the amount of data in your credit profile usually will beat out a pretty polished high score with a thin profile, with a lack of data. So keep that in mind. This self-reporting, these utilities can be very beneficial to you. What's the broader impact on the wealth gap for those of us that are not on the proper side of it? Renters gain recognition. This is something that is long overdue. Renters will gain recognition. Bridges the renter to owner gap. Now, instead of having to, go through the mortgage process and try to negotiate to get these things to count for you, you can get these things automatically uploaded through a self-reporting company and have them already generated and factored into your credit report. So when your lender pulls your credit report, you're automatically assessed and scored already based on-time rent payments. So this makes it that much easier by the time you go to apply for a loan for a home, that you've already been accounted for good on-time payments with your utilities, your rent, etc., your housing. It rewards consistency over privilege. We're talking about closing the wealth gap. those of us that don't come from the best or most advantaged background can now benefit from this new change with credit scoring models incorporating rent payments, utility payments, phone payments, even if we don't come from a privileged background, because now these are bills that almost all of us are paying regardless, versus somebody who's never had to be responsible for their own finances and inherited credit or inherited resources. So this gives a little bit of a closing of the gap, if you will, or balances out the playing field a little bit, because now those of us that are stuck with, whether we're poor, working poor, or well off, we're all stuck with the same bills. That's one thing that levels the playing field, if that makes sense. So as I always close out in these videos, what's the relationship banking tie-in for this? How can your banker benefit you from this? Well, this is important. Not everyone should opt into this immediately. Strategy beats shortcuts. Connect with your banker and figure out, is this something that's actually beneficial for me? Because those of you that may not know, sometimes you add on things that look positive on your credit report in your mind, and they actually hurt your score because it just depends on your profile. This may not be beneficial for you. So you do need to sit with a banker who can help you take a look at your credit profile and give you some insights on, yeah, this could be beneficial for you. Or you know what, this might not be as favorable for you for said reasons. So make sure you connect with a banker or financial expert to take a look at this before you just jump on it and start adding on these self-reported items, okay? Comment down below and let me know how you see this being beneficial for you or somebody that you know or care about, how this can help close the wealth gap. Let me know if you're already using self-reporting services and how it's affected your credit score and your credit profile. Comment down below. So all my pioneers, welcome back. To my new viewers, welcome in. I want you to like, comment, share, subscribe, support the channel so the channel can continue to support you. For those of you who are new to the channel, I'm a career banker and financial services professional by trade, 14 plus years in the industry, state mortgage loan originators license, life insurance license, FINRA investment license, and small business banking certified. I manage a client relationship book of around $25 million between consumer clients and small business clients in deposits and investments. So you're getting this information from somebody who has their neck deep in the field, helping clients with this exact type of information on a regular basis to help them increase their net worth. So I appreciate you for tuning in. I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.